So over the course of this quarter, we further reduced our equity exposure within the portfolios, particularly in the international developed markets as well as emerging markets. Now in the international space, we're seeing a continued slowdown in economic data, a high degree of sensitivity to a slowdown in global trade, and at the same time, the central banks in those regions have far less room to actually support their economies. In the emerging space, we know that this ongoing, what we see now, a more prolonged trade dispute between the US and China will have impacts not just on China, but to the broader emerging region as well. We took a look at how we invest in smaller companies and decided to consolidate our allocation to small cap Canadian equities and small cap US equities into a single global mandate that we believe provides a more flexible approach to investing in smaller companies. We also looked at our real asset allocation, where today we have not only an investment in real estate and infrastructure, but now include an allocation to global natural resources through a strategy that focuses on sustainable and renewable resources in that space. Today we're underweight equities within our portfolio, but we do have a relative preference for areas such as the US, where economic growth is still reasonably strong, and there's still that ability for central banks to support their economies through added stimulus. We also favor more defensive areas of the equity market, such as real assets. Now in the bond portfolio, again, we're favoring quality over higher yielding, riskier components of the credit market. And we also hold a moderate allocation to cash. In today's environment, cash actually yields better than long-term bonds, so a very useful asset to have within the portfolio today.